I've spent over 5 decades studying markets, economies, and the patterns that repeat throughout history, and I need to share something with you today that keeps me up at night. Not because I'm worried about my own wealth, but because I see millions of good, hardworking people making a decision right now that could cost them everything they've worked for. Let me start with a simple question. Do you think the $100 bill in your wallet today is worth the same as a $100 bill from 20 years ago? Of course not, right? You already know this intuitively. But here's what most people don't understand. The rate at which your money is losing value is about to accelerate dramatically. And if you're keeping your savings in traditional bank accounts or certificates of deposit, you're essentially watching your wealth evaporate in slow motion. Now, I don't say this to scare you. I say this because I've seen this exact pattern play out multiple times in my career. In the 70s, in 2008, and every single time, the same group of people gets devastated while another group not only survives but thrives. The difference between these two groups isn't intelligence. It isn't luck. It's understanding how the economic machine actually works. Think about the economy like a giant, complex machine. I've talked about this before. This machine has gears, and each gear represents something different. Productivity, credit, inflation, employment, debt. When all these gears turn in harmony, everything feels stable. You go to work, you get paid, prices stay reasonable, and life goes on. But right now, several of these gears are grinding against each other in ways that create massive friction. And in 2026, that friction is going to create sparks that will burn those who aren't prepared. Let me tell you about something that happened in my own career that taught me this lesson viscerally. In the late 1970s, I was a young analyst, and I watched families, good families, who did everything they were told to do. They saved money, they avoided risk, they kept their cash safe in banks. And by 1980, these families discovered that despite doing everything right, they were dramatically poorer. Not because they spent recklessly, but because the value of their dollars had been cut in half by inflation. Meanwhile, I watched other families, often less educated, less sophisticated, who owned rental properties or had invested in stocks or even just bought gold. These families came out ahead, way ahead. And that experience burned into my brain a fundamental truth. Safety is an illusion when you don't understand how money actually works. So let's talk about how money works, because this is where most people get confused. Money isn't a stable thing. It's not a rock you can hold on to. It's more like ice. It seems solid, but it's constantly melting. The rate at which it melts depends on how much new money is being created. And right now, we're in a period of unprecedented money creation. Between 2020 and 2022, the United States created more money than in its entire 240-year history combined. Read that again. More money was printed in 2 years than in 2 centuries. Now, that money didn't just disappear, it's still in the system. And like water finding its level, that money is going to flow into prices. Food prices, housing prices, energy prices, everything you need to live is going to cost more, a lot more. But here's the part that really matters to you. When this happens, there's a transfer of wealth. A massive silent transfer from people who hold cash to people who hold assets. This isn't a conspiracy. It's not some evil plot. It's just mathematics. It's how the system works. It's always worked this way. Let me explain this transfer in a way that makes it crystal clear. Imagine two neighbors. Let's call them Tom and Sarah. In 2020, they each had $50,000 in savings. Tom decides to keep his money safe in a savings account earning 3% interest. Sounds responsible, right? Sarah, who's been reading about economics and inflation, splits her money between stocks, real estate investment trusts, and a small amount of gold. Fast forward to today. Tom now has about $58,000 in his account. He made $8,000. He feels pretty good. Sarah's portfolio is now worth around $82,000. She made $32,000. But here's what really matters. The purchasing power of Tom's $58,000 is actually less than what his original $50,000 could buy back in 2020. He worked for 5 years to earn that interest, and he's actually poorer. Sarah, on the other hand, not only preserved her purchasing power but increased it significantly. Same starting point, same 5-year period. Completely different outcomes. This is the transfer I'm talking about. And it's accelerating now. I know what some of you are thinking. But Ray, investing is risky. I could lose money. And you're absolutely right. Investing does carry risk. But let me ask you this. Is it riskier to possibly lose some money in the short term? Or is it riskier to guarantee that you lose purchasing power every single year for the rest of your life? Because that's the choice you're actually making. The financial world talks about risk wrong. They define risk as volatility, as the possibility that your account value goes down. But real risk, the kind that actually destroys families, is the risk that your money won't be able to buy the things you need when you need them. And ironically, the so-called safe choice of keeping everything in cash is almost guaranteed to create that exact outcome. I want to share something personal with you. Over my career, I've made a lot of money. But you know what I'm most proud of? It's not the returns I generated. It's the fact that I've helped people understand these principles early enough that they could protect themselves. There's nothing more satisfying than meeting someone 10 years later who tells me they watched one of my talks, made changes, and it transformed their financial life. If you're getting value from this conversation, I hope you'll stick around because we're going to go deeper. And maybe, just maybe, this could be that moment for you. Let's talk about what's coming in 2026 specifically. I'm seeing four major forces converging, and each one is like adding fuel to an already burning fire. First, the national debt. The United States now owes over $33 trillion. That's not a typo. 33 trillion. And the interest on this debt alone is now consuming over $1 trillion per year. Think about that, just the interest payment, not paying down the principal, not funding new programs, just servicing the existing debt is eating up more money than almost anything else the government does. Where does this money come from? They print it. They have to. Second, demographics. Every single day, more than 10,000 Americans turn 65 and become eligible for Medicare and Social Security. This isn't going to stop. It's going to continue for the next 15 years. These are promises the government has made, and they're going to keep them. But keeping those promises requires money. Lots of money. Money that doesn't exist. So what do? They print it. Third, geopolitical competition. Whether you like it or not, we're in an economic and strategic competition with China, Russia, and other powers. This means military spending, infrastructure spending, technology spending. No matter who's in the White House, no matter which party controls Congress, this spending is going to happen. It's considered essential for national security. And where does this money come from? You guessed it. Fourth, and this one's flying under the radar, there's a crisis brewing in the banking system. Hundreds of regional banks are sitting on massive unrealized losses in their bond portfolios. When interest rates were near zero, these banks bought long-term bonds. Now that rates are higher, those bonds are worth dramatically less. These banks are technically insolvent. They just haven't had to mark those losses to market yet. But eventually, they will. And when they do, the government will step in to prevent bank failures. With what money? Printed money. Four massive forces all pointing in the same direction. More money creation, more inflation, more transfer of wealth from cash holders to asset owners. Now, some of you might be thinking, but inflation has come down from its peak. The Fed raised rates. Things are getting better. And on the surface, that's true. Inflation did peak at around 9% and has come down to around 3 to 4%. But let me ask you something. When was the last time you went to the grocery store and felt like things were cheaper than last year? When was the last time your rent went down? Your insurance premiums, your energy bills, the official inflation number and the inflation you actually experience are two very different things. And even if we accept the official number of 3 to 4%, do you realize what that means over time? At 4% annual inflation, your money loses half its purchasing power in just 18 years. If you're 40 years old today planning to retire at 65, your retirement savings will be worth half of what you think they're worth in purchasing power terms. Let me paint you a picture. Imagine you've worked hard your whole life. You've been responsible. You've saved $1 million for retirement. Sounds great, right? You feel secure. But if you kept that million in cash equivalent investments earning minimal interest, and inflation averages just 5% per year over the next decade, by the time you actually retire, your $1 million will have the purchasing power of about 600,000 in today's terms. You'll have $1 million number on your statement, but it'll only buy what 600,000 buys today. That's not a small problem. That's the difference between the retirement you dreamed of and a retirement where you're constantly worried about money. And the tragedy is, this is completely avoidable. So what do? How do you protect yourself? Let me walk you through the principles I follow, the same principles I've used to navigate multiple financial crises and come out ahead every single time. First principle, diversification, but smart diversification. Most people think diversification means owning a bunch of different stocks. That's not real diversification. Real diversification means owning different types of assets that respond differently to the same economic conditions. Think about it this way. If inflation accelerates, what happens? Stocks might struggle. Bonds definitely struggle. But real estate often does well. Commodities often do very well. Gold historically shines during inflationary periods. You want to own a mix that protects you no matter which scenario plays out, a solid baseline structure. And remember, this isn't specific advice for you, this is educational. Might look something like 40 to 50% in quality stocks, particularly companies that can raise prices without losing customers. Think about companies making products people need regardless of economic conditions. 20 to 30% in real estate assets. This could be direct property ownership or real estate investment trusts. 10 to 15% in commodities and precious metals. Gold, silver, even industrial commodities. 5 to 10% in inflation-protected securities, and then 10 to 15% in cash for emergencies and opportunities. Notice that last part. Only 10 to 15% in cash. You need some cash for emergencies and to take advantage of opportunities when they arise, but you don't want so much that inflation destroys it. Second principle, quality matters more during inflationary periods. Not all assets are created equal when money is losing value. You want to own businesses with pricing power, companies that can pass increased costs onto their customers without those customers running away. A utility company that provides essential services, they can usually raise prices. A luxury goods company whose customers are wealthy, they often have pricing power. A commodity producer like an oil company, they naturally benefit from rising prices. What you want to avoid are companies drowning in debt, companies in hyper-competitive industries where they can't raise prices, and fixed income securities that don't adjust for inflation. Third principle, time is your friend if you use it right. The biggest mistake I see people make is trying to time everything perfectly. They wait for the perfect moment to invest. They wait for markets to drop. They wait for clarity. Meanwhile, inflation is eating their lunch every single day they wait. You can't time markets perfectly. Nobody can, not even me. But what you can do is position yourself appropriately over time. If you're moving money from cash into assets, do it gradually over 6 to 12 months. This way, you're not betting everything on one moment in time. You're averaging in, which reduces your risk and gives you time to adjust if conditions change. Fourth principle, your time horizon determines your strategy. If you need money in the next 2 to 3 years, you have to be conservative, even if it means losing some purchasing power to inflation. Short-term volatility can be worse than inflation over short periods. But if you don't need the money for 5, 10, 15 years, then you can absolutely afford some volatility in exchange for inflation protection. In fact, you can't afford not to. Fifth principle, stay flexible. The economy is dynamic. What works today might not work tomorrow. The key is having enough liquidity and enough understanding that you can adjust as conditions change. Set aside time every quarter to review where you stand. Are your allocations still appropriate? Has your personal situation changed? Have economic conditions shifted? Stay engaged, stay informed. If you found these principles valuable, you're probably someone who thinks deeply about your financial future. There are a lot of voices out there giving financial advice, and I hope you'll keep coming back here for perspectives grounded in decades of real-world experience, not just theory. Now let me address some objections I hear all the time, because I know some of you are thinking them right now. Objection 1. I'll just wait for the market to drop before I invest. I understand this impulse. Nobody wants to buy at the top. But here's the problem. While you're waiting for that drop, inflation is costing you 3, 4, 5% per year guaranteed. That's a guaranteed loss. and markets might not drop, or they might drop and then recover before you feel comfortable jumping in. The opportunity cost of waiting is often much higher than the risk of starting now. Objection 2. Gold doesn't pay dividends or interest, so it's a bad investment. This shows a fundamental misunderstanding of what gold is for. Gold isn't an investment in the traditional sense, it's insurance. It's a store of value that's maintained purchasing power for literally thousands of years. When paper currencies collapse, gold endures. You don't own gold to get rich. You own gold to stay rich, to preserve what you already have. Objection 3. The stock market is at all-time highs. It's too expensive to buy now. I've heard this objection my entire career, and you know what? The market has made new all-time highs hundreds of times over the decades. That's what markets do when companies are productive and economies grow. Yes, there will be corrections and bear markets, but over the long term, owning productive assets beats holding cash every single time. Focus on value, not on price levels. Objection 4. This all sounds too complicated. I'll just stick with what I know. I get it. Finance can feel overwhelming. But you know what's really complicated? Trying to retire on money that's lost half its purchasing power because you avoided learning these principles. The cost of ignorance is far higher than the cost of education. Let me share a story that illustrates everything I've been talking about. In the 1970s, my colleague had two uncles. One was a banker, highly educated, conservative in every way. He kept all his savings in bank accounts and bonds. The other uncle was a plumber, not formally educated in finance, but he understood value. He bought a small apartment building with a modest down payment. His apartment building had tripled in value. His rents had increased with inflation, and he was financially secure. Same family, same decade. Completely different outcomes because of different understanding of how wealth is actually preserved. You might be wondering, Ray, what are you personally doing right now? That's a fair question. I'm heavily diversified across asset classes, just like I described. I own stocks in companies with pricing power. I own real estate. I own gold and other commodities. I own inflation-protected securities. And yes, I keep some cash, but only enough to handle emergencies and take advantage of opportunities. I practice what I preach because I've seen firsthand what happens to people who don't. As we move through 2026 and beyond, you're going to see this wealth transfer happen in real time. You're going to see people who kept everything in cash starting to panic as they realize their purchasing power is evaporating. You're going to see headlines about inflation, about currency concerns, about the cost of living crisis, and through all of that noise, there will be a group of people who position themselves correctly, who will not only preserve their wealth but grow it. The question I have for you is simple. Which group do you want to be in? This isn't about getting rich quick. It's not about speculating or gambling. It's about understanding fundamental economic principles that have been true for centuries and applying them to your specific situation. It's about being a student of history and learning from the patterns that repeat over and over again. I know change is hard. I know it's easier to just keep doing what you've always done, to keep your money where it feels safe, even if that safety is an illusion. But I also know that 5 years from now, 10 years from now, you'll look back at this moment and you'll either thank yourself for taking action or you'll regret that you didn't. The economic machine is already in motion. The gears are already turning. The forces I've described, the debt, the demographics, the geopolitical spending, the banking system vulnerabilities, these aren't going away. They're intensifying, and their impact on your purchasing power is going to accelerate. But here's the beautiful thing. You still have time. Not a lot of time, but enough. Enough to educate yourself, enough to make a plan, enough to start repositioning your assets in a way that protects you instead of exposing you. Think about the people in your life who depend on you, your spouse, your kids, your future self. They're counting on you to make smart decisions, to see around corners, to protect what you've worked so hard to build. This is your opportunity to do that. I've been studying economics and markets for over 50 years. I've managed billions of dollars through multiple crises. I've seen boom and bust cycles come and go. And I'm telling you with absolute conviction that keeping significant money idle in cash or cash equivalents over the next few years is one of the riskiest things you can do. The risk is silent, it's slow, but it's absolutely certain. Why? Don't let paralysis analysis stop you from taking action. You don't need to have everything figured out perfectly. You just need to start moving in the right direction. Talk to a qualified financial advisor if you need help. Read books, watch educational content, learn about different asset classes. But whatever you do, don't just sit there and let inflation steal your future. The principles I've shared with you today aren't complicated, but they are powerful. Diversify across real assets. Focus on quality. Take a long-term perspective. Stay flexible. Implement gradually. These principles have worked for decades, through multiple cycles, and they'll work for you if you apply them. I hope this conversation has given you valuable insights. I hope it's motivated you to take a hard look at your own financial situation and ask yourself if you're truly protected or just feeling a false sense of security. And I hope you'll continue seeking out knowledge and perspectives that challenge you to think differently about money and wealth. The transfer of wealth I've described is already happening. The only question is whether it's transferring away from you or toward you. That decision, that choice is in your hands. Choose wisely. Your future self will thank you. Remember, we're all in this together, trying to navigate an increasingly complex economic environment. But knowledge is power, and understanding how the machine works gives you an enormous advantage. Use it.